Hey everybody, hey traders, Chris Pulver here. It is aftermarket on August 14th. We just closed up here about an hour ago. And just taking a look, a little lackluster on the performance side. Pretty quiet day considering we had CPI news come out. A couple highlights with the data. We printed 2.9% year over year. And I think this is a pretty good illustration with how stuck we are with the US inflation situation right now. We go back to July of 2023, where we had around the same print. There's a 3%, 3.2, 7, 7, 2, 1, 4, 3.1, 3.2, 3.5, 3.4, 3.3, 3%, 2.9. So if the market's getting excited about anything, it's probably this right here with having a pretty steady 1, 2, 3, 4, 5 readings of lower inflation. The problem is it's not really improving for the last year. Not yet. Now, are there still deflationary pressures? Possibly. The Fed has discussed that they may not have to wait, nor are they going to wait for the inflation readings to get below 2%, because that would mean that they kind of let inflation overshoot to the downside and they might start cutting rates sooner than that. So, the first thing I looked at this morning when the news popped at 8:30 a.m. Eastern time was the CME futures FedWatch tool, and this is pricing in about a 60% chance that the Fed will cut rates still in September. But this keeps jumping back and forth from cutting 50 basis points back to 25, back to 50 basis points, 25. When we had our scare back on August 5th, that was jumping up to 75 basis points, back to 50 basis points. Here we are. I think right now it's kind of settled in that the market's expecting a 25 basis points cut coming in September. If we go to November, this is looking for another cut. So September would be a 25 basis points cut. November, as of right now, is still tossed between a 25 basis points and 50 basis points cut, and December, another probably 25 basis points cut. So, according to the Fed, in inflation, we're just going to see a couple of rate cuts by the end of the year. Going into the new year, I would imagine that right now it's looking like almost every Fed meeting planned for next year is looking for another cut by the Fed. So, what do we pay attention to now? Well, a couple things in the charts, but let me talk about tomorrow. We do have some sensitive data tomorrow that comes out at 8:30. Also, we have unemployment claims forecasted for 236. I think for the market to be excited and be happy, this probably needs to come in lower, 230, 225, 220, or as low as possible to probably show that the labor market is stabilizing and we're not letting unemployment slip too high. Retail sales testing the consumer. How's the consumer right now? Savings, low, debt, high, credit card debt, spending, all that's high. The consumer is getting stretched. Cutting right now, does it help? Maybe. 12 months from now, depends on if the consumer can hang on that long. I do think that we're going into a slowdown, but I'm not ready to call this, massive bearish top at this time. If we look at the charts, this is probably the thing I'm watching the closest. To me, the ES feed is a little bit simpler to read because we have more liquidity throughout the 23, 24-hour trading days. And so where we are at right now is we had a high to low, lower high to lower low, and we're right back up to the same area. Now, for the bulls, I think that the bulls would have to make a pretty convincing break, not just through the trend line, but hold this level and look to see if we can get back to these highs again. We're not that far off. We made a pretty miraculous recovery from this high to low. We've already pulled back around 50%. So if I put a Fibonacci here from high to low, we're looking around 50 to 55% pullbacks already, possibly getting back to that 618. Do we reject in the next 2 days? Do we reject off of that trend line and have the bulls, poke here, but then fail? And we'll see what the bearish candle gives us. Last Thursday, last Friday, last Monday, huge bearish candles. Again, a volatility event, Japanese yen unwinding, Asia's meltdown, the Fed missteps, all these things were getting thrown in the markets right away. But I'm seeing a lot of convincing cases out there with some smart macro analysts that are suggesting that we're not done yet necessarily. Cautiously optimistic, cautiously bullish. As we get into the next couple of weeks, we do have Jackson Hole coming in next week on Thursday, Friday, and Saturday. Obviously, what's tradable for us is Thursday, Friday. We wrap up the month on the 30th, and then we kick off September. Historically speaking, these are not good months for the market. If I look at month to month on the SPX or the SPY, Let's have a look here. Typically, it's September and October that are the worst performing months in the stock market. So I'll come back to that in just a moment. But as we get through Jackson Hole is usually a lot of noise, a lot of nothing. Let's go to a couple of our instruments here. So today we did print higher. We've been pushing higher all week. Let's go to the weekly time frame. We had 3 aggressive bear candles, and we've had this huge push to the upside with another follow through this week. So, is that it? I don't know. You can see my yellow boxes here. This is for my personal trading. I am still looking at some positions to hedge here over the next maybe 30 to 60 days just to be on the safe side in case this market wants to turnover in any way, shape, or form and try to make an attempt to retest these lows. The one indicator that I'm still watching closely would be my 200 exponential moving average. On the S&P, we didn't touch it. We're still back here for the last touch around, this would have been November of 2023. And we've stretched a decent amount. We're not quite to 200 bars, but we're close. We're around 195 bars. I do wonder, and I don't know, I somehow think that this market is not necessarily done. I just wonder how obedient this potential bear channel could be. Would it be out of the question to see the market do something like this, where we can connect the low and all of a sudden we see the market topping out in here and start to make its way lower? We do in fact try to test the low, and all of a sudden we have some lows getting tested. The high of the year looks harder and harder to find, and the market may make a more convincing, bottom, but we might be stuck. We might see a low that pulls back halfway again. We might see a attempt to try to get back to the highs, but that would be difficult. If we have, 10, 12, 13, 15% correction, does that shed all the potential risk out there? Not necessarily. So I don't know. It really is a toss up. I'm kind of at a coin flip for a lot of my trades right now. Obviously, if the market goes up, that's easy for the portfolio. If the market goes down, I am playing a lot of defense and hedging quite a bit over the next, like I said, 30 to 60 days, just to make sure that if something nasty were to happen, that I'm going to be making more money on the downside than it would be in positions getting hurt. And of course, I want to see what sectors are affected the most. Is there something that you can hide out in? Is it better to be in bonds right now? Is it better to be in cash right now? And I kind of go both ways. I mean, my cash position right now is around $500,000 of buying power, and I'm looking to keep it there and hopefully maintain it. But I want to make sure that I'm not just throwing cash at bad positions, and I want to make sure I'm very mindful and crafty with how I construct my trades. So I do have some ES hedges to the downside. I do have some NQ hedges to the downside, just in case we're going to come back and retest this low. Like I said, through Jackson Hole through September, we do have a decent round of data. So coming into tomorrow, so Thursday, August 15th, we have retail sales and we have core retail sales. We also have unemployment claims, which happens every Thursday. All right. And we are pretty much wrapping up with earnings for Q2. Then we go into next week. Next week, we will have Jackson Hole. And that is Thursday through Saturday. Usually, Jackson Hole is fairly and unnecessarily volatile. And like last year, we had earnings right around Jackson Hole. It was a wild week. I mean, I remember this last year. NVIDIA had a huge gap around earnings, and Jackson Hole's at the same time. We went up and then dropped and then went back up again. It was a mess for a couple of days. This week, or this next go around, the Jackson Hole meetings are next week, and NVIDIA is out another week into the 28th. So if we go to NVIDIA here, you can see that the earnings report is after market on the 28th on Wednesday. So that will be after Jackson Hole. NVIDIA, I mean, for the top, 1, 2, or 3 stock in the world at 2.9 trillion, what a wild ride this has been. This thing has dropped 35, almost 36%, and has pulled back about the same amount. So we're up around 29.8% on this little bottom. Just go back to this simple chart here. We came right back down to the close to it, didn't hit it, but came back down towards it, the 200 exponential moving average. So I do have to wonder if this 200 EMA just starts doing its thing, if price continues to head up higher, if NVIDIA has decent earnings again, is that enough to get it back to the highs? If so, I'd be interested in looking for a short-term opportunity there with some option trades and see if we're going to be in some sideways territory for a while. Obviously willing to take my chances with some bear call spreads. probably not long puts. I think that's going to be tough to time. But I mean, it could pay well. It just depends on what the implied volatility and the prices look like. But credit spreads are always pretty good with defined risk. And if I want to call a top, I can do it that way and not get hurt on the wrong side of it. So I will be watching closely. If we're sitting right in the middle going into earnings, right? If Nvidia's right here going into earnings at the end of the month, is it going up to the highs, going down to the lows, and we get into September, I wouldn't be overly optimistic about the markets being able to make new highs, nor make new lows, and we just kind of grind through this next like 30 to 60 days. So there's a lot going on here. I do think that the market was scared very quickly. I think the market was quickly deleveraging. The one thing I've been noticing the last couple of years is there is a lot to unpack when it comes to how fast these cycles are happening now. And I just continue to look at my positions, make sure I'm not doing anything silly, stay the course, keep my trades mechanical, keep my risk defined. I do feel the need to put out some more hedges just in case. My hedges are typically 5 to 1 or 10 to 1. They cost about 0.25% of my account, but pay out maybe 4 to 5% profit. They're low probability, but they're there just in case I need them. It's just like insurance. I mean, if it pays out, it actually is an insurance policy that can pay you, unlike fighting with your insurance company. Haha, inside joke. But anyway, I'm looking at this trend line area. This channel, could this be a resistance level, and we come back down to flush and retest these lows? And if so, I do have those bear traps down here. If we do poke those lows, we would officially hit that 200 EMA on the ES or the SPY or the SPX. And to me, that's a little bit more of a buying opportunity that I'd like to kind of sustain, but also being prepared for, we might see a bear market like we saw back in 2022. Not this correction here, although this was very similar to what we just saw. So having, this correction in the summer of last year, we were down double digits, I believe. So this correction from high to low was around 11%. And we just did that exact same thing, but did it within a matter of, 3 weeks. So rather than going high, low, lower, high, lower, low, lower, high, lower, low, we did all that with that very aggressive move to the downside. So are we going to have a similar summer correction like we had in 2023, or are we about to have a rougher correction like we saw through most of the year in 2022? I don't know, okay, but I will be watching. My charts are pretty clean, pretty simple. I'm trying to watch price action, trying to be fairly objective. I do think that if price comes back into this window here, if the bears are going to step in any way, shape, or form, I think this is where they step in. So if we have a bit of a fake out and price goes bearish, I'm more aligned with a bearish move over the next maybe 2 to 3 weeks. If the bears are going to fall off a cliff again, do they come back down and tap these lows? If so, do we have another like nasty volatility spike? I don't know. But the VIX, by the way, has gone from this spike up here, the 65 level, which you haven't seen since COVID, haven't seen since 2008. Had an interesting report that I got from Tasty Live yesterday, that only I think 5 times in history of the VIX have we gone over 35. So even all throughout 2022 and even throughout 2020, I mean, only a few times in history have we gone over 35. So this was an outlier type event. This really happens about 2 to 3% of the time. So it's hard to say like this is how I have to plan moving forward. But man, was it just a nasty volatility event? And here we are back down to 1620, which realistically, as we started to topple over in July, this is where the volatility was in the first place. So are we going to settle back into this kind of $16, $17 area and maybe pop back up into the 20s? I would be really, really surprised and almost annoyed if traders are so disrupted by a volatility event like this, and then the market just settles right back into this complacent zone in the low teens, and we just grind away and get to all-time highs again. I don't think that is likely the case. I think that after this type of VIX suppression, my SVXY position has been doing great. I have 55, 54, 53 puts, 35 puts. My break even would be 49 and change if I were to take ownership. I'm really just using it as an income trade right now. If we end up spiking back up, I could see just a little bit, this high, settle into a low, come back maybe, to the 25 or 35 area, maybe, and then settle back in. Let me look at the VIX term structure here really quickly. Let's go VIX term structure. There we go. So now this is completely flipped. We're sitting here at 16.19. This is actually calling for higher. Interesting. This is calling for higher volatility over the coming months as opposed to lower. Over the last couple of weeks, if you watched any of my videos, and I was checking on this term structure, this green line, which is the actual price of the VIX, was up here in the 20s got into the 1918 zone, and we were looking for this blue line to then head lower. Now it's flipped. So here we are looking for slightly higher volatility moving out over the next 30 to 60 to 90 days. So again, it's going to be interesting, but I'll go back to the simple chart. Okay, we go back to a chart like this. What happens at this trend line? If the bulls poke up here, they better poke and pause to show that they're going to stay here with no bears on the other side. Because if they poke and get rejected and the bears come in with a big engulfing candle or some, pretty significant move to the downside, like we had on Thursday, Friday, post FOMC, then I'm more in line, like I said, with a bit of a bearish move to the downside. And I would be looking to target these closes or maybe even those wick lows over the next maybe 30 to 45 to 60 days. So in the near term, I'm watching really carefully. I'm not overly bearish. I'm not overly bullish. I'm just kind of letting things play out. I'm defending myself to the downside. I'm seeing my P&L from this little bottom has been going up, every single day since last week, Tuesday, even Monday for that matter. But I just don't feel super confident that this is it. Like if that was the low, again, investors have a look at that and also be mad that what kind of buying opportunity is that? You have an 8% crash in 3 days and this is the bottom. What are you supposed to do when the market's panicking and it seems like we're going to be in a recession? There's emergency Fed cuts on the horizon, so you think, and this is the one opportunity to actually buy. I mean, that is insane, but that's what happens when you put in sentiment and emotions to these markets. Because if it was just, if it's just mechanics, just robots, just capitalism, we'd probably have more of a market that just does this. Not a lot of oscillation, right? But you throw in fear and greed and extremes and highs and lows, and it gets all over the place. And that's what makes a market. You got bulls, you got bears. Don't be a pig, right? Bulls and bears make money, pigs get slaughtered. You know the deal. So, okay, that'll do it for me. Hope you enjoyed the video. Hope this helps. Like I said, I'm watching a lot. I don't really have a great plan outside of I'm watching price carefully. If we see a fake out and then a rejection, way more interested in looking to see if there's bears that are following through here. If the bulls are going to break, they better break and pause and hold this level with an absence of sellers because this market can then continue to drift up, maybe even poke those all-time highs. But that, again, wouldn't surprise me if this is some type of extreme where we have a 10% dip on the SPY or the S&P or a 20% dip in the NASDAQ and we're right back to the highs and we just shrug it off. I mean, these market cycles have been crazy fast. Now, one more thing before I go. I will say that if this channel is accurate and we come back down to hit the lows, my concern is that if we do some damage here and we come all the way back, and these are the original lows for the year, we would not be that far away from going up 18%, giving back most of those gains, and then having the rest of the year, maybe carve out a couple percent. Remember, the S&P as an averages around 7 to 9% a year. So if we finish just above these January highs around single digits, well, it was a good first half of the year, but a lousy second half of the year. Now, history says that if we have a first half that is greater than 10%, the second half is usually also performing positively. So if we have a better than expected first half at 10%, beating the annual averages, the second half tends to drift and stay in motion. So that's also why I think, if we have a little bit of a pullback would be fine, right? But then we have the market justify, make a clean break here, and then try to get back to these highs. And we just kind of stay in this bullish trend, this bullish market. But I just want to know, how much damage has the market experienced from a trend line break like this, a trend line break like this, or just going farther out. If we go all the way back to these lows, maybe this market is looking more of a longer term trend line like that. Okay, and we have previous highs here, we have previous highs here. I mean, there's all sorts of ways to justify where would I buy. Well, I would be interested in buying here. I'd be interested in buying here. I look at my percentages as well. If we're down 15, 20, 25, 30%, I'm going to take some ownership of the SPY. I might sit in a drawdown for a little bit, right? I mean, maybe the SPY corrects deeper than 25 or 30%. But I do think that give it time, lower my cost basis, use options, and be pretty active with my trading, that I can own the SPY very, very cheap and eventually give it, 2, 3, 5 years. We get back to highs and all of a sudden you have your gains where I own it. I lower my cost basis, lower my cost basis, lower my cost basis the whole time. And eventually when we get back to highs again, I just increase my overall net profit potential. So that's the beauty of taking core positions and working with options. So anyway, there's still lots to do, lots to unpack here. And news comes out tomorrow morning. And look for another follow video from me. So I'll talk to y'all soon. Happy trading, lots of profits. See you then. Bye.